All right, let's get right into it. We're going to tackle what is maybe the most important distinction in all of finance: investment versus speculation. Seriously, getting this one thing right, it can change everything for you. So let's dive in and really unpack it.
And I want to kick things off with a pretty blunt question for you. Think about it. When you hit buy on a stock, are you actually investing, or are you just, well, gambling? It's a tough question because that line has gotten so blurry lately. But figuring out which side of that line you're on, that is absolutely everything.
So why is it so blurry? Why is it so hard to tell the difference? Well, to get to the bottom of that, we have to look at the environment we're all playing in. Because, let's be honest, in a lot of ways, the modern market has been set up to feel just like a giant flashing casino.
And just like in a casino, the house has some advantages, right? Think about it. We've got these zero-commission trading apps, which sound great, but what they really do is encourage us to trade all the time. Then you've got the financial media, just this constant storm of noise, 24/7, making it almost impossible to think clearly. And social media? Oh man, that's where stories and hype spread like wildfire, pulling everyone into the same trades. And on top of all that, you have these super complex products that make you feel sophisticated, but really, they're just hiding a ton of risk. Okay, so with all that chaos, how in the world are we supposed to navigate it? How do we find our way? Well, we're going to turn to an anchor in this storm, the timeless wisdom of the guy they call the father of value investing, Benjamin Graham. He gave us a super clear, super precise definition of what investing actually is. And here it is, this one sentence, this is our North Star. Graham said, "An investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return." Just listen to how clear that is. And he didn't stop there. He added something huge. If what you're doing doesn't check all three of those boxes, then it's not investing. It is, by definition, speculation. Period. So this isn't some fuzzy, feel-good idea. It's a rock-solid three-part test. Let's break it down. Number 1, thorough analysis. That means you've actually done the homework on the business, not just staring at the squiggly lines on a chart. Number 2, safety of principal. This is all about making sure you don't lose your money for good. It's your defense against getting totally wiped out. And number 3, an adequate return. Are you getting paid enough for the risk you're taking on? And here's the kicker. If you're missing even one of these, you're not investing. You've crossed the line. So, that simple three-part test, it creates two totally different kinds of people in the market. You're either the investor or you're the speculator. And this chart just lays it all out, side by side. Look, the investor is focused on the business, on what makes it tick. The speculator? They're just mesmerized by the price going up and down. The investor's number one job is to not lose money. The speculator is chasing a hot story, hoping to get rich quick. An investor is looking for a good enough return, while the speculator is just trying to ride the emotional waves of the market. And maybe the biggest difference of all, the investor always builds in a margin of safety, a buffer, while the speculator is basically flying without a net.
Okay, let's zoom in on that safety thing, because this is where so many people get tripped up. Safety of principal does not, I repeat, does not mean the stock price won't drop tomorrow. It's going to do that. It means protecting yourself from a permanent, game-over kind of loss. This safety isn't something you hope for, it's something you build before you even click buy, by digging into the company's financials and being super conservative. So it's not about avoiding bumps in the road, it's about making sure you don't drive off a cliff.
And here's another idea that might feel a little backwards at first, but it's so important. The goal is an adequate return, not a maximum one. Why on earth would you want that? Well, because that desperate scramble for the highest possible return, for that 100x winner, that's the very thing that pushes you over the line from investing into pure, high-stakes speculation. It's where you start taking on insane risks without even knowing it. Okay, so the theory sounds good, right? It sounds smart. But does it actually work when things get crazy? Does it hold up in the real world? Well, let's find out. Let's look at the proof, at what happens in the moment of truth. Yeah, this is really where the rubber meets the road. Take a look at the history. Back in 2008, the speculators who were loaded up on debt got absolutely crushed, wiped out. The investors who had focused on companies with solid financials, they survived. Then fast forward to the pandemic crash in 2020. The speculators panicked, they sold everything at the bottom and locked in huge losses. The investors? They were looking at business durability and actually did great on the other side. And just recently in the 2022 tech wreck, everyone who piled into those story stocks got hammered.
But the investors who stuck to their discipline on valuation, they held up way, way better. It's like a law of nature. The market always separates the investors from the speculators in the end.
So what does this all mean for you? What's the big takeaway here? It's this: deciding whether you're an investor or a speculator isn't just some intellectual game. It is the foundational choice that will determine pretty much everything about your financial future.
Seriously, everything is built on this foundation. How you build your portfolio, what stocks you actually pick, how you act when the market is crashing, it all comes down to this one choice. And your use of a margin of safety, which is just a fancy way of saying you buy things for way less than they're worth, that's the cornerstone. If you build your financial house on the foundation of speculation, I'm telling you, no fancy strategy is going to keep it from falling down.
I think this last quote from Graham just sums up the entire mindset perfectly. He said, "The intelligent investor is one who sells to optimists and buys from pessimists." Now, that doesn't mean you're just trying to be different for the sake of it. No, it means you use your brain when everyone else is losing their minds to fear or greed. It's about being the cool-headed business analyst in a room full of screaming fans.
So there you have it. We've walked through the definition, we've looked at the mindset, and we've seen the real-world proof. You now have the exact framework that Benjamin Graham laid out. You can use it to look at everything you do in the market. So the only question that's left is the one we started with, and now it's up to you to answer it. Which one are you?